Well, we just recently passed the halfway mark of the year. We're now well into July of 2025. And what are we looking at in terms of high conviction investment opportunities for the second half of this year? Well, in today's video, I'm going to discuss two blue chip, high yielding dividend growth stocks that I think are opportunities that I have a high degree of certainty will deliver satisfactory or very likely outsized total return performance moving forward, while also paying out very attractive and growing passive income through dividends. Before I get into these topics though, if you like getting dividend content, some of my top picks like I'm going to share today, some of my highest conviction dividend picks, as well as my analysis of popular dividend ETFs, as well as overall strategy and philosophy for how to build a dividend portfolio that's likely going to deliver outsized income over time and also outsized total returns, please subscribe to my channel to get future content. Thank you so much. It means a lot. Okay, so what are some of these top picks that I really like? Well, the first one I'm going to talk about today is Realty Income. Realty Income is a triple net lease REIT, or real estate investment trust. It owns a very large, well-diversified portfolio of thousands and thousands of individual properties that have triple net leases assigned to them. And these triple net leases are very conservative in nature. Basically means that the renter of the property is responsible for virtually all of the operating and maintenance expenses, and that you're simply earning a spread on capital. So you buy the property, you may finance it. For example, Realty Income will typically finance their property mostly with equity, but with a little bit of debt, and then they lease out that property to a tenant at a higher yield on the rent relative to their cost of capital to purchase the property, which is a combination of their equity costs and their debt costs. These leases tend to be very long-term in nature, 10 to 20 years. They have contractual rent escalators throughout the term of the lease to help offset the corrosive effects of inflation. And so over that 10 to 20 years, they typically recoup most, if not all, of their investment. And then when the lease is done, they can release the property. And typically over that 10 to 20 year period, inflation means that rent rates have increased materially. So then when they release the property, typically they can earn a much higher rent rate as well. So that leads to further appreciation and cash flow growth over time. Also, Realty Income typically gets a lot of high quality tenants. A large percentage of their rental revenue comes from investment grade tenants, but even some of their non-investment grade ones are still pretty good quality. They tend to locate their properties in highly valuable, highly durable areas, so they're able to attract good tenants, and the tenants are not willing to break those leases. Those are maybe some of the last properties they would break in their portfolio of properties where they lease them from landlords. And they also have diversified their portfolio across all over the United States, as well as into Europe now and some other countries as well. So they have significant geographic diversification as well. So if one area of the country gets hit hard economically or from a natural disaster, the rest of the country can cover for that. And so Realty Income has really built a very well diversified massive real estate empire. It's almost like a real estate ETF in and of itself. And also the vast majority of its properties are resistant to recessions as well as e-commerce headwinds. So that also makes it a very stable cash flow source. And that's what Realty Income's history has shown over many years. It has generated very stable rents, has been able to grow its dividend year after year after year. As a result, it's now a dividend aristocrat with over a quarter century of consecutive dividend hikes. And not only has it grown its dividend every year, but it's grown at a very consistent rate over time, has beaten inflation by growing its dividend at a mid-single digit annualized pace. So it's one of the best possible income machines you can get. In fact, it's nicknamed the monthly dividend company because it pays out its dividends each month. And so you get that really nice dividend cash flow every month that increases steadily over time to beat the corrosive effects of inflation. So when you have combined the defensive characteristics of its triple net lease portfolio that's broadly diversified and structured such that it's resistant to recessions, with the fact that it has an A- credit rating from S&P, so one of the strongest balance sheets in the entire REIT sector, with the fact that it has such a lengthy and impressive track record of generating stable cash flows, generating market-beating returns, and growing its dividend to shareholders, along with the fact that today you can get a forward dividend yield of nearly 6% by buying shares of Realty Income, or ticker symbol O. On top of that, you can buy it on a price to NAV basis that is at a clear discount to its historical averages, as well as even a discount to the underlying private market value of the real estate assets that it owns. It is a highly compelling buy. It's very rare that you can buy such a well-diversified, well-managed portfolio that's backed by such a strong balance sheet that gives you such incredible diversification and the liquidity that owning these small shares in the company provides you at such a compelling valuation. And so between the huge economies of scale that O offers as well, makes the management quite affordable. And again, the growth profile, the growth pipeline, I see O as being a highly compelling, high conviction opportunity. Sure, it's not going to grow super fast. sure, it's not going to make you rich overnight. And yes, O is very interest rate sensitive because of the long duration cash flow structure. It's often viewed as a bond proxy. And so when long-term interest rates rise, O tends to fall in stock price as the market expects a higher dividend yield from the shares. But when long-term interest rates fall, O's stock price shoots higher. And over the long term, if interest rates, they may gyrate here and there, but if they remain in a steady band, I think you're going to see the growth kick in, potential for price to NAV multiple appreciation over time. And so you're going to get a pretty solid return. You get that near 6% yield plus probably 4%-ish AFFO per share growth. That alone gets you at 10% plus the potential for price to NAV multiple appreciation plus the potential for price to AFFO appreciation. And when NAV will go up as interest rates fall, which I think is a decent chance of happening in the not too distant future, you're looking at a low to mid-teens annualized total rate of return, which is very attractive for such a low risk investment that is virtually a slam dunk to not only keep paying its current dividend, but grow its dividend over time. That's especially valuable when you consider there's a lot of macroeconomic uncertainty right now with what are the effects of the tariffs going to be? Is the Fed going to cut rates too soon, too late? There's a potential for trade wars to erupt, to escalate between the US and Europe, or some of the US and China, for example. Or what if China invades Taiwan? That's expected by many. If that were to happen, it would plunge the world into a depression. And so a more defensive investment like Realty Income that's mostly focused in the United States and has basically zero exposure to Taiwan or China would likely hold up much better than many other investments out there. And so it's likely that O would be able to keep paying its dividend even through that kind of environment, given how well it did during, for example, the great financial crisis or even the COVID lockdowns, kept growing its dividend through those storms. And so while I wouldn't expect it necessarily to benefit on a growth basis or an intrinsic value basis in such a scenario, it would likely hold up way better than most other stocks out there, give you that passive income through a very difficult time. So there are a lot of reasons to like O as a ballast for your portfolio, especially if you're a more conservative, income-focused retiree. Okay, before I get into the second pick, if you like this content, please, again, consider subscribing to my channel and also give the video a like. That would greatly help in its distribution and it would mean a lot to me. Thank you so much. Okay, so the second pick that I have high conviction in that I'm going to talk about today is Energy Transfer. Now, this does issue a K1. It's an MLP, but I like MLPs a lot. If you don't want to deal with the K1, I encourage you to look at ETFs like MLPA or AMLP. Those both issue 1099 tax forms, or you can even look at CEFs like NML or SRV. Those are also actively managed. They're closed-end funds, but they issue 1099s as well, and they have portfolios of MLPs in them as well. Okay, so Energy Transfer, what about it? Well, it's one of the largest MLPs. It's well diversified by different segments. It also has exposure to two major tailwinds that are for many MLPs or midstream companies right now. One has a pretty large natural gas business that is well positioned to benefit from some data center construction, especially in Texas. Management has mentioned this on recent earnings calls that they expect to get some tailwinds from the AI boom. Additionally, they are a big player in LNG exports. They've been signing contracts with companies in places like Japan, for example, to export a lot of energy commodities through their ports, which would enable them to make a lot of money over time, and that's a major growth avenue for them. Another reason I really like them is their next 12-month distribution yield is nearly 8%, and they expect to grow that distribution at a mid-single digits pace. They have a target rate of about 3 to 5% annualized distribution growth, and management has indicated on recent earnings calls that they expect that to be towards the higher end moving forward, since they're now at the low end of their target leverage ratio. That gives them more financial flexibility. On top of that, when you have that 8% yield plus that roughly 4 to 5% annualized growth rate, that alone gets you to an attractive total return. But they also now, with their increased financial flexibility, because in addition to having a low leverage ratio, they're covering their distribution by nearly 2 times with distributable cash flow. They are looking at repurchasing units. Now they've already repurchased all the preferred equities that they can. There's one series of preferred equity that they're not able to redeem that way, but they could repurchase that on the open market if they wanted. But they, so now they are also looking at, okay, they've improved their balance sheet. They've reduced their cost of capital by redeeming a lot of those preferreds. They can potentially keep paying down debt to deleverage further, but they like their current leverage ratio. And so they're looking at potentially repurchasing units. And that creates additional intrinsic value by increasing distributable cash flow per unit, thereby further increasing the coverage ratio for their distribution, which means they could potentially accelerate the distribution growth rate in future years as well. So there's another big reason to like ET. Another big reason to like them simply is that they are retaining so much cash flow that enables them to invest opportunistically and even aggressively in additional growth opportunities. And Energy Transfer is famous for being a very aggressive growth investor, perhaps too aggressive. That led to them having to cut their distribution back in 2020 when the energy market crashed due to COVID. They decided to slash their distribution to deleverage to preserve their investment grade balance sheet because they had so much growth going on. But in a more bullish environment, which I believe we are in right now for midstream energy, it can be a good thing because they have such a large portfolio. They have many growth projects they can invest in on an organic basis. They also have a lot of bolt-on acquisition opportunities that they can pursue, which they've done in recent years with great success. And that can be a very accretive way of growth, as well as further diversifying and de-risking the business. So there are a lot of reasons to like ET. A last reason to like it is simply that its enterprise value to EBITDA valuation multiple and its price to distributable cash flow multiple are both among the lowest among fellow blue chip investment grade midstream companies. And so there's potential for valuation multiple expansion there as well, on top of the attractive yield plus dividend growth rate or distribution growth rate that's expected to beat inflation in the coming year. So a lot of reasons to like ET. That's one of the reasons I own it, why I'm bullish on it. I have high conviction that it's very likely to deliver very satisfactory double-digit annualized total returns over time moving forward. So if you like this video, again, ET, two high quality, high conviction, high yielding investment opportunities with investment grade balance sheets. Please give the video a like. Let me know in the comments below what you think of Realty Income and Energy Transfer, as well as any other blue chips that you may like right now. And make sure you subscribe to the channel for more content like this in the future. Thank you very much. See you next time.